Right, friends. So let's start with part 2, okay, of this particular chapter, portfolio management. So we'll go with CAPM. So what is that? Capital Assets Pricing Model. So hereafter in shortcut, we'll call it as what? CAPM. Okay, that's gonna be the wording that we'll be using. CAPM. Now, so let's try to understand what are the topics that we're gonna cover under this. Okay, so under this CAPM, let's try to understand that. So first we'll look into the intro part, okay? Then we'll look into, let me put it this way. I think this would be better. Calculation of beta, that will be the next one. Then we'll try to understand what do you mean by portfolio beta. All right, so we'll try to understand what do you mean by portfolio beta. Then we're gonna understand something called beta management. Okay, then we'll try to understand calculation of alpha, what is alpha and all that. Then we will try to understand something called asset pricing, and finally systematic and unsystematic risk. Systematic as well as what, Nana? Unsystematic risk. So these are all the concepts that we're going to cover under part 2 of this particular chapter, and that is CAPM. I hope you guys are writing along with me. You got to write. Your examination is all about writing. Okay, it's not an MCQ examination. Please keep that in mind always. Your examination is not MCQ. You got to write in the examination, so you have to practice that. Only then it's gonna work. All right. Okay. So these are all the things that we're gonna see, buddies. So let's have a look into this once more, guys. So what are all the concepts that we're gonna cover? Introduction to CAPM. Then we're gonna cover something called calculation of beta, then portfolio beta, then beta management, and then alpha, then asset pricing, and finally systematic and unsystematic risk. All right. Okay. So let's start with the first part. So what is the first part that we're gonna have? Introduction. You start along with me, everybody. Okay. So let's start with the first part, Nana, that is introduction. Okay, now understand one thing. Sir, what is that, sir? We have already seen something called modern portfolio theory, isn't it, by Markowitz? Okay, we have already seen that. From that, if we are trying to move to some other theory, okay, called CAPM right now, then definitely common sense should tell you that there are certain basic problems with modern portfolio theory. Otherwise, why would you go for something new? See, just like, I don't know whether you guys could remember, SCMP, but that's okay. In SCMP, if you could remember, just try to understand the logic over here. Otherwise, just leave it, ignore it, okay? In SCMP also, you have performance measurement systems. Initially, you'll have performance measurement systems based on numbers, purely financials, and then because of that you'll get some problems, and as a result you go for something called balance scorecard, and because of balance scorecard also you get some problems, and as a result you go for something called performance prism. Like that, here also we have something called modern portfolio theory. We have some problems with that, there are limitations, and as a result we are going for something called CAPM. So even when it comes to this particular modern portfolio theory, as we have discussed already, so there should be some problems, and that's the reason we are going for something called CAPM. Now the biggest question is, what are the problems that we have when it comes to modern portfolio theory? That is what we are trying to understand. Ready? Chalo, write along with me. We have 3 problems in MPT. What is MPT? Modern portfolio theory. And that is the reason why we are going for something called CAPM. Are you able to understand? Right? We have already discussed something called capital market theory as well, isn't it? Right. So we know the logic. First of all, there are some problems, and that's the reason we are going for something called, yeah, CAPM. Right. So what are those three problems? Let's try to understand. First, too much data. Okay, you require too much data as per modern portfolio theory to analyze what is the risk of a particular stock, which stock to buy, what is the required return or expected return from a particular stock. You need to calculate covariance, you need to calculate correlation. There are a lot of data work that you have to do. Okay, so too much of data. For example, I'll write the example here. We need expected return calculation, we need standard deviation, we need covariance, isn't it? We need correlation. Let's say there are two stocks, so I've taken it as XY. Are you able to understand? So too much of data requirement. Okay, that is the first problem. Okay, next, second problem is it is very difficult for you to find out correlation. Small r means correlation. Let me put it this way. Very difficult to find out correlation between two stocks of different sectors. Say same sector, say for example you are in telecom sector. Okay, now you try to find the correlation between Jio and Airtel. It's pretty easy, right? It's pretty spot on. With certain data you should be able to calculate. It's gonna be relatively easier and relatively possible, first of all. But when I have to find out correlation between two stocks of different sector, for example Airtel and Mahindra, that becomes really tricky. It becomes very complex. It becomes very complicated. You understand the point? And when you can't calculate correlation, obviously you cannot understand the relationship between those two stocks, and you cannot keep those two stocks in your portfolio unless you know how these stocks are going to move with each other, isn't it? Only then you can plan your portfolio, isn't it? Once you do not know what is the correlation between two stocks, especially when they are of different sectors, then if correlation calculation becomes very difficult, then automatically portfolio build up, the building up of the portfolio also will be pretty difficult, isn't it? All right, logical reasoning there. You got it? Right. I'll just draw a diagram and then I'll try to give you an example. For example, let's say you have some stocks like A, B, C, D. Some four stocks you have got. Now, if you want to find correlation between these four stocks, what do you have to do? Let's say correlation is in the middle. Then you have to find correlation between AB, right? You have to find correlation between AD. You have to find correlation between AC, right? You have to find correlation between CD. You have to find correlation between BC, right? And you have to find correlation between BD. I hope I have covered everything, right? You see that? Too much data demanding, right? Too much of calculation you have to do. And that too, lot of correlations you have to calculate, and calculating them also is going to be really difficult. You understand the point, right? So that is problem number 2. I'll explain it further. Just listen right now, okay? Then you have the last problem. What is last problem? Problem number 3. In modern portfolio theory, we focus on total risk of stocks, okay, and can be reduced. What can be reduced? Risk can be reduced, okay, with the help of diversification. Okay, diversification means obviously you'll try to bring in more stocks into the portfolio. The greater the number of stocks, we have already seen, automatically your risk gets reduced, isn't it? Right? But here, only unsystematic risk gets reduced. Very important. But not systematic risk. Unsystematic risk means diversifiable risk. Okay, a risk that you can reduce because of diversification. That will get reduced. But what about systematic risk? Anyway, you can't reduce it or able to understand. First of all, modern portfolio theory does not talk about systematic risk. It's as simple as that. It talks about only the unsystematic risk. It talks about only the diversifiable risk, the risk which you can reduce because of diversification. Are you able to get me? So that's the basic problem, right? Anyways. Okay. Let me finish this off. All right. Okay, fine. See, always this is very important, Nana, because unless you know, unless you know what are the problems with modern portfolio theory, you will not be able to understand what is CAPM. Why should we go for something called CAPM? Are you able to understand? So these are all the problems that we have got. So we're gonna understand this a little better. Now let's see here. Let's say there are 4 stocks. How many stocks we have got? 4 stocks. A, B, C, D. Now, suppose if you apply modern portfolio theory to these stocks, and you have to decide which stock you want to invest, how much you need to invest, what is the expected return from each of these stocks, what is the standard deviation of each of these stocks. Are you able to understand how many stocks I need to have in my portfolio? So then what you have to do, you need to calculate expected return for all these stocks. You need to calculate standard deviation for all these stocks. You know that's a hectic job, isn't it? Especially standard deviation calculation. Then you need to find covariance between two stocks. Then you need to find correlation for all these stocks. Then again, you need to find out optimal weights. So it's a lot of, what is that? Data calculation. So it eats away a lot of time. Now let's say it is 4 stocks. Okay, that's fine. Then what about 20 stocks? Then it will take too much of time for calculation, isn't it? Right? By the time you finish calculation, market price of the stock would have got changed. You keep on calculating, it's not going to work that way. Are you able to understand? Because market price is getting fluctuated every single minute. So you can't invest your money in companies of different sectors for diversification, as it is very difficult to calculate the correlation, which I've explained you over here, isn't it? Right? Different sectors means I gave you the example, telecom sector and automobile sector. That is, what is that? Airtel and Mahindra, right? If you want, I'll write it over here as well. Airtel and Mahindra, so that you'll understand it better. You got it? All right. And not only that, I already told you that MPT does not talk about systematic risk. Modern portfolio theory talks only about unsystematic risk. That is a risk which you can reduce, or diversifiable risk because of diversification. It does not talk about systematic risk, correct? Then what does CAPM do? Now, okay, sir. Now we are talking about CAPM, correct? Capital Asset Pricing Model. Okay, you have already told me that these are all the problems in MPT. We do have some good problems, good number of problems in modern portfolio theory. And that's the reason we are going for something called CAPM. Right, now you tell me, what is the so-called speciality of CAPM? All these problems are going to get solved when it comes to CAPM? Of course. How? Do we need too much of data requirement when it comes to CAPM? No. How can you say that? What CAPM says is that, see, why are you comparing, one stock with the other stock? Like that, if you have 200 stocks, you have to compare all these 200 stocks, one with the other. And that too, there will be a lot of combinations possible like this. Only in case of 4 stocks, these many combinations are possible. Imagine if it is 10 stocks, how many combinations, permutation and combinations are possible? That makes things very complicated. So what CAPM says is that, see, you stop doing this nonsense, okay? You stop comparing each stock with the other. You stop calculating covariance with each and every permutation and combination. You stop calculating correlation with each and every permutation and combination. Let's try to make it relatively simple. What is that? Let's start comparing with market. Comparing who with the market? Comparing a stock with the market. For example, you have stock A. Compare that with market. Stock B, compare it with the market. Stock C, compare it with the market. Stock D, compare it with the market. So 200 stocks I've got, compare it with the market. And accordingly take a decision. Sir, comparing with the market, how to take the decision? Because ultimately I have to compare two stocks, right? Yes. But once you have a common factor, see, I'll tell you a simple example. Now try to understand. I have a class of 100 students. In these 100 students, I want to find out the meritorious students, the intellectual students. What will I do? I'll keep an exam. Okay. And I'll have a base. The base is 100 marks. The exam is for 100 marks. Are you able to understand? And then I'll try to identify who are all the students who have scored greater than 80. Those are all the students I want to send them for some international competition. Say for example, there are some 5 students who have got 80 plus. I've conducted the exam. The base marks is how much? 100. 80 plus, I've got 5 students. I've sent it for international competition. Are you able to understand? Sir, why are you saying this example, sir? Is it, I don't think it is anyway related to our current concept. Yes, it is related. How, sir? Similarly, I want to select 5 best stock for my portfolio. How will I select? To select that, like how we have 100 marks here. 100 marks is the best. 100 marks is the base to select meritorious students whom I need to send for international competition. Correct? Like that, I need a base here, and that base will be the market. By comparing with the market, that market is nothing but 100 marks here. How you are able to select the meritorious students, the good students, like that, here I am going to select the stocks. This is the simplest way I can make you understand. Hereafter, once we start solving it, you'll be able to understand automatically. But right now, this is a basic understanding that I can give you in a simplest way possible. How? By taking 100 marks as the base, you were able to identify the meritorious students, correct? Similarly, by taking market as a base, you'll be able to identify which are the stocks that deserve to be in your portfolio. In other words, the best performing stocks. Everybody wants to have best performing stocks only. Nobody wants to have what? Worst performing stocks. That's obvious. Are you able to understand? Just like you want meritorious students to go to those international competition from on behalf of your school, isn't it? Similarly, in my portfolio, I want to have the best performing stocks. How will I know that? By comparing with a base, like 100 marks in this case, right? What is 100 marks or base in this scenario? Market performance. Individual performance of stocks will be compared with the market performance, and accordingly decision will be taken. What stocks I need to be in my portfolio, what stocks I don't need to be in my portfolio. See here. CAPM talks about relationship of stock with economy. With economy means actually it is market. So market means what will be taking here? Sensex or Nifty. Actually, it includes much more than Sensex or Nifty, but practicality purpose will be taking only Sensex or Nifty. Okay, and not other company of either same sector or different sector. Okay, so basically what CAPM talks about is that a relationship of any stock with the economy, not with other company. So we are not discussing about relationship of one stock with a stock of another company. No, one company stock with another company stock relationship. No, I am trying to compare the relationship of what? A particular stock of a company with market. Are you able to understand with whom? Market, right? That is nothing but in simple words, Sensex or Nifty. Got the point? Now, this is measured with the help of something called beta. I hope we have already discussed about beta in the previous chapters. Anyways, one more time, we'll try to understand beta in a very detailed manner in this particular chapter, that is portfolio management. Got the point? All right. Anyways, so right now that much is enough for you. Sir, what about this? You have written something called budget, interest rate, depreciation of rupee. See, these are all the different aspects that will influence the economy, which will anyway be reflected in Sensex or Nifty. Anyway, that will be reflected in Sensex or Nifty. Na? Therefore, once you take the market, which is Sensex or Nifty, automatically you're considering all these things indirectly. Are you able to get me? Anyway, they'll be reflected. See, if there is depreciation of rupee, what will happen? It will have its effect on the market. If there is interest rate increase or interest rate decrease because of RBI policy change, it will be reflected in the market. If there is a good amount of budget which favors industry released by government in a particular year, it will be reflected in the market. So indirectly, once you consider Sensex or Nifty, you are considering all these things only. Na? Got the point? Right. Anyways, fantastic. All right. I hope till here you guys have written. Now just take this down. Take this down, we'll continue. So I'll just show you a comparison diagram over here. Just take it here itself. So this is modern portfolio theory. This diagram, correct? Now CAPM means I'll just draw a diagram so that you'll understand it better. What is the difference? See here. I'll use the same color. Here, what is there in the middle? Correlation, isn't it? And then you are trying to find out the correlation between different stocks. Now let's say same situation we have here. A, B, C, D. 4 stocks we have. Okay, when it comes to CAPM. So what is that we're gonna do? We're gonna compare A, B, C, D with whom? With market. That is Sensex or Nifty, which we can also call it as economy. So we're gonna compare all the individual stocks with the market. Are you able to understand? Where the economy is getting reflected in a way, right? It's not a direct way, but it is an indirect way, right? Okay, anyways. Now you start copying this one. All right, Nana. Copy it. Yeah. Slowly I'm scrolling it down. Take it down, guys. In case if you are not able to find time, especially people who are watching video classes, so what you guys can do is that you can just pause the video, okay, and then you can copy. But take down the notes, make proper notes, Nana. That is really important. Notes making is very important for cracking your exams. All right. All right, guys. Chalo. Slowly scrolling down. All right, guys. Okay, I hope this is done, isn't it? If you guys are finished, we'll move on. All right, now, shall we start? All right, chalo. So now we know that when it comes to modern portfolio theory, they were considering only one type of risk, that was unsystematic risk or diversifiable risk, which you can reduce with the help of diversification. Any company can reduce for that matter. But when it comes to one of the criticism that we gave was the modern portfolio theory was not at all considering something called what Nana systematic risk, which is very important. Whereas CAPM, what it does, it considers both types of risk. Both types of risk means one is systematic risk and the other one is unsystematic risk. Okay, so let's try to understand them first. In CAPM, there are two types of risk. Okay, so what are they? One is systematic risk and the other one is unsystematic risk. So therefore this negative point also is covered, which means that negative point has been solved, right, as per CAPM, because it considers both systematic as well as what, Nana? Unsystematic risk, right? All right. Okay, now let's try to understand what is this. We already do have an idea what is systematic risk, but anyway, I'll try to explain here better. Okay. Systematic risk means we can say it is market related risk. Unsystematic risk means it is company specific risk. Is that clear? To put it in a very simple perspective, because of the individual decisions a company takes, if that company is facing a particular risk which is within the control of that particular company, we call it as unsystematic risk. So basically, can the company reduce that particular risk? Yes, it is within their ambit of control. Then what about systematic risk? It is definitely not within the control of the company. For example, suddenly recession comes and every single company in an economy will go down. For example, recently it has happened in case of COVID, right? So is it within the control of the company? Because of COVID, if the business goes down and because of that your stock price goes down and all that, is it within the control of the company? No. So that we call it as systematic risk. It is something that is related to the market, like COVID, like recession. There are so many other factors which are not within the control of the company, or able to understand, because of which a company will face a risk. For example, automobile industry is there. There is something called, let's say, international crude oil prices are increasing. Brent crude price is increasing. The barrel price is increasing. As a result, people are buying less number of cars or something like that. Are you able to understand? And that's the reason, if you can see, Maruti recently they have launched, what is that? Grand Vitara, and Toyota has launched its sibling called the High Rider, and they're going with strong hybrid, which gives you a mileage combined with petrol somewhere around 28 kmpl, isn't it? So which means what we are trying to understand here is that, so this is a factor, the international crude oil price, which is absolutely not within the control of any automobile company in India, whether it is Tata or Mahindra or Maruti Suzuki, but still they are getting affected because of that, isn't it? And that is nothing but what we call it as systematic risk, which is absolutely not within the control of the company. Whereas unsystematic risk is something which is within the control of the company. They can reduce it with the help of diversification. Okay, right. So that point only we will write now. So what is that? This cannot be reduced with the help of diversification. Okay, whereas this can be reduced, okay, with the help of diversification. Okay. Okay. Next. How to measure? Now here comes the fun part. Systematic risk. Can it be measured? Yes, we already know, isn't it? We have seen in the earlier chapters. That is, this can be measured with the help of something called beta. Beta measures systematic risk, right? What about unsystematic risk? Can it be measured? It cannot be measured, unfortunately. Now that's the fun part. Systematic risk can be measured, but it cannot be controlled. It is not within the control of the company. Unsystematic risk cannot be measured, but it can be reduced. It can be controlled, right? That's the fun part. Okay, sir. Sir, can you give some examples so that we'll understand it better? You have told the concept of what is systematic risk, what is unsystematic risk. Give me some examples, sir, so that when we revise, it will be easy for us to understand it. Yes, of course. So, example, interest rate risk. Is it within the control of the company? No. GDP. Is it within the control of the company? No. Currency, appreciation or depreciation. Is it within the control of the company? No. Inflation. All these are examples for what? Systematic risk. What about unsystematic risk? Your individual company management problems, your decision making skills, okay, your labor problems, which is not specific to the industry as a whole, but it is specific to that particular company. Are you able to understand? Suppose there is a labor strike that is happening. That's your problem, Ray. That's your company's problem. So can you solve it? Yes, you can. Because of that, if you are facing any risk, yes, you can absolutely solve. Got it? Anyways, that's it. Okay. So beautifully, I've given you in the form of a table over here. I hope this is clear. All right. Now let's come to the main part, that is equation of CAPM. Okay. All right. Let's go with that. Ready, guys? So what is the next one? Equation of capital asset pricing model. All right. Okay. So as per CAPM, okay, required return. Okay, required return or required rate of return, okay, which can be represented in the form of RE or KE. Okay, is calculated as under is equal to required rate of return is equal to RF plus beta into RM minus RF. Okay, this is for an individual stock, for a security. For a security. Similarly, you can also calculate this for a portfolio. Okay, what about portfolio? RE required rate of return of a portfolio is equal to risk-free rate of return plus beta of the portfolio into market return minus risk-free rate of return. Okay, this is for a portfolio. All right. Okay, here RP is nothing but we know required rate of return. Okay, this is beta. This is market return, isn't it? We are already aware of all these things, okay? And this is risk-free rate. So nothing new as such, okay? All right. All right. So now we're gonna understand the logic behind this formula, okay? Okay, let's try to understand the logic. Now listen carefully. Next 10 minutes, it's going to be very important. I want you guys to focus completely and then try to understand. Okay, 100% focus, 100% focus. Okay, and you'll be enjoying as well. See, let's say our bit 2 is there. Okay. Now bit 2 has some surplus cash. Okay. Let's say he has got 10 lakhs surplus money or surplus fund. Let's put it this way, surplus fund. He doesn't want to keep this surplus fund idle. He wants to invest. So what bit 2 thinks is that he goes to risk-free return, let's say RBI bonds, and then he sees that RBI bonds means obvious risk-free rate. It is somewhere around 6%. He wants to invest in that because standard deviation is 0. There is no risk whatsoever, isn't it? Even beta is also 0, isn't it? For risk-free rate, what is there, isn't it? So he knows that once I invest this 10 lakhs, I am far sure I'll be getting 6%. All right. Now, there is a company. Let's say this company is, okay, Mahindra and Mahindra. And for this, there is an MD. Okay, only for our understanding purpose, we are trying to understand the logic over here. Okay. And his name is, let's say, Thomas. Okay. Now, listen carefully. This MD wants money for his company. Are you able to understand? He wants bit 2 to invest here. Okay. Now what he does is that he goes and talks to bit 2, and then he says that bit 2, please try to invest over here. Where in our company we have a fantastic company called Mahindra and Mahindra. You please try to invest your money here. Now tell me, will bit 2 will invest? He will say, why should I invest? Because here my risk is 0. What is the risk of bit 2 here? Risk of bit 2 is equal to absolutely 0. So I know that once I invest my 10 lakhs in RBI bonds, I know that I'm going to get 6% for sure. Now, why would I invest over here? Because definitely your company, Mahindra and Mahindra, of course, it's a great company, especially in past 3 or 4 years, the business is, really great. They're actually rocking the industry. Everything is fine. But still, why would I invest? Obviously, your risk is higher when compared to RBI bonds. Thomas says, yes, bit 2, I can understand. Yes, our risk is high, but I will compensate for that higher risk in the form of higher return, which we call it as risk premium. How much risk you feel that you are taking extra by way of investing in our company rather than investing in RBI bonds, that much we will compensate you by paying additional return, which the additional compensation that you pay for the additional risk that somebody is taking, we call it as risk premium, isn't it? So we are already aware of it. So it is nothing new, isn't it? Now bit 2 starts to get convinced. Okay, fine. So you try to say that you accept that the risk in your company is more. If I try to invest in your company, definitely my risk is going to be more. And you're also trying to say that, okay, you're going to compensate me by paying higher return. Okay, right. Then bit 2 starts thinking, okay, how much is the additional risk that your company has got when compared to what? The so-called RBI bonds. For that, what bit 2 tries to understand is that he tries to understand what is the industry where this Mahindra and Mahindra is operating. Now, here bit 2 tries to understand that Mahindra and Mahindra is operating in automobile industry. Isn't it? And then he tries to understand what is the overall return that automobile industry earns. He tries to gather the data and he gets market return, and the market return of automobile industry is, let's say, 15%. So what do you mean by this 15%? It means that anybody who invests in an automobile industry on an average will get 15%. You got the point? Then also bit 2 tries to find out. So bit 2 says that, see, Mr. Thomas, I would like to invest in your company. I'd like to give my money, 10 lakhs. And your company operates in automobile industry, and on an average, this industry gives a return of 15%. So straight away, there is a risk premium of how much? There is a risk premium of 9%. Because normally when you invest in RBI bonds, you'll be getting 6%. But if you try to invest in any company in an automobile industry, on an average, the market return of automobile industry is 15%, which means I'm getting 9% extra. Correct? Now, what Bittu tries to say is that, Mr. Thomas, if your company Mahindra and Mahindra and the risk of your company is on par with the automobile industry risk, that is market risk. Suppose market risk is something and your company risk is something. If both of them are on par with each other, then if you pay me 15%, I'm happy. Are you able to understand? Which means if your company's risk is on par with market risk, and if you pay me 15%, which on an average, anybody who invests in this particular, industry, in this sector, is what they are expecting to get, then I'm okay with 15%. Now the question is, if the company's risk is equal to market risk, then it means that beta should be 1. This we already know. So what is beta? Change in the stock return divided by change in the market return. Correct? If beta is 2, what does it mean? It means that if market return changes by 1%, suppose it becomes 16%, then your company's return will change by double. Here it changed by 1%, here it will change by 2%. Correct? I'll try to explain this in depth later. Right now, just have a basic understanding. Okay. So beta 1 means if market return changes by 1%, stock return also, your company Mahindra and Mahindra return also will change by 1%. If market return changes by 2%, your company's return also will change by 2%. Therefore, if beta is 1, it means that the risk of your company is equal to the risk of the market. Therefore, on an average, the market gives a return of 15%, where there is a risk premium of 9%. So if you pay me the same 15%, I am ready to invest in your company, provided beta is 1, which means the risk of your company is equal to the risk of the market. But, if the risk of your company is greater than the risk of the industry, then you have to pay me for the more. Or if the risk of your company is less than the market risk, then you can pay me less. Either way, it should work. So now, therefore, let's see how this formula applies. Now let's apply this formula. What is the formula? Required rate of return is equal to risk-free rate plus beta into RM minus RF. Now in this example, what is the risk-free return? 6%. 6 is minimum, bare minimum that you have to pay, plus beta times the risk premium. What is beta here? 1. Beta 1 means what? The risk of Mahindra and Mahindra is equal to risk of the market. So beta times the risk premium. What is risk premium? On an average, the market return is 15% minus risk-free is how much? 6, which means the risk premium is 9%. So therefore, 6 plus risk premium, 1 into 9, it will be 9. If you pay 15%, that's enough. Okay, required rate of return. I should be writing RE. Here we are not talking about portfolio. Okay, individual security. RE. You got the point? RE. Suppose beta of Mahindra and Mahindra is 2, not 1. Then what is the situation? I will say, if you give me a risk premium of 9%, I'm not happy. Because risk premium of 9% is happy, provided if your company's risk is equal to the market risk. But if your company's risk is double that of the market risk, then give me double the premium. Then I will not accept 9%, I want 18%, I want double the premium. Are you able to understand? So if your beta is 2, it means that your risk is double the risk of the market, which means I need double the risk premium. So therefore, in that case, if you look at the formula, how it's gonna work? RE, required rate of return, is equal to RF plus beta into RM minus RF. That is equal to RF is 6% plus beta 2 times the risk premium. Risk premium is nothing but 15 minus 6, that is 9%. So therefore, 6 plus 2 times 9%, that is 18%, which means it's gonna be 24%. I hope now you guys have understood the formula. It's pretty simple. Got the point? And you have understood the logic as well. Got it? Now earlier when we have seen capital market theory, I told you that I'll be explaining the logic of this particular formula. Here also you see the logic remains the same. If you can see here, RF same, plus beta is nothing but, what is beta? What is beta? Change in stock return divided by change in market. Is that clear? Suppose if it is a portfolio, then change in the return of the portfolio divided by change in the market. Change is nothing but risk. So risk of the portfolio divided by risk of the market. That is nothing but here, risk of the portfolio divided by risk of the market. This is nothing but beta into RM minus RF. So basically this formula is what I have explained you right now. RF plus beta, which is nothing but sigma P divided by sigma M, that is risk of the portfolio divided by risk of the market into RM minus RF. So actually it is the same, only it has been presented in a different way, that's all. So it is nothing different. So beta is nothing but change in stock return divided by change in market return. In other words, beta is nothing but change in stock return is nothing but risk of the stock, how much it changes, right? That is nothing but risk divided by risk of the market. Now here I'm not talking about stock, I'm talking about a portfolio. Then in the place of security or stock, you'll get portfolio. Then risk of the portfolio is nothing but sigma P divided by risk of the market. So sigma P divided by sigma N is nothing but beta. So if you remove these two and you substitute that with beta, it is the same formula that we have got as per capital asset pricing model, isn't it? Are you able to understand? And for CAPM model, I've already explained you the logic here. Isn't it? How this formula has come with the help of B2, right? So this is clear. All right, chala. Is that clear? Right. We'll just take some example. I hope you guys have copied this along with me, right? Logic of the above formula. Otherwise, I'll just pause the video and then copy now. Copy, Nana. If I'm trying to scroll it faster, okay, if you feel that way, just pause the video and then copy, okay? So that should not be a problem for you. All right, that's the last one. Finish it off. Guys, finished? Sure. Okay, we'll wind up the session here. In the next session, what we'll do is that we will cover security market line. Okay. After that, we'll try to understand different methods, various methods of calculation of beta, and then we'll proceed further. Okay. Right, guys. Thank you.